Hello everyone, and welcome back to the channel. Today we're diving deep into a topic that affects every single one of us, no matter where we are in the world: the global economy. The International Monetary Fund, or IMF, has just released its updated World Economic Outlook, giving us a fresh look at what to expect through 2026. So what's the big picture? Is it time to be optimistic, or should we brace for more uncertainty? Let's break it down together. First, the headline number. The IMF has adjusted its global growth forecast for the coming years. For 2024, they're projecting a growth of 3.2%, which is a slight uptick from previous estimates. This suggests a surprising level of resilience in the global economy, especially considering the headwinds we've been facing, like high interest rates and geopolitical tensions. They're keeping this same 3.2% forecast for 2025 and 2026 as well, painting a picture of steady, albeit not spectacular growth. So where is this resilience coming from? A big part of the story is the United States. The US economy has consistently outperformed expectations, driven by strong consumer spending and a robust labor market. This strength has a ripple effect, helping to support global demand. However, the IMF also points out that this strong US performance is one of the reasons inflation has been a bit sticky, prompting the Federal Reserve to be cautious about cutting interest rates. Speaking of inflation, that's the other side of the coin. The good news is that global inflation is expected to continue its downward trend. The IMF sees it falling from an average of 6.8% in 2023 to 5.9% in 2024, and then further down to 4.5% in 2025. This gradual cooling is a positive sign, suggesting that the worst of the post-pandemic price shocks might be behind us. For the average person, this means that hopefully, the pressure on our wallets will start to ease up a bit. But the story isn't the same everywhere. The report highlights what it calls a divergence in economic performance between different regions. While advanced economies like the US are showing strength, others are facing bigger challenges. For example, the euro area is seeing a more sluggish recovery, weighed down by the lingering effects of the energy crisis and weaker industrial output, particularly in Germany. The IMF has actually downgraded its forecast for the eurozone, highlighting this growing gap. Now let's turn our attention to emerging markets and developing economies. Here, the picture is also mixed. Countries like India are expected to be bright spots, continuing their strong growth trajectory. The IMF projects India will grow at a very healthy 6.8% in 2024. China, on the other hand, is grappling with a deep property sector crisis and weaker consumer confidence. While its economy is still growing, the pace has slowed, and the IMF projects it to moderate further, falling to 4.6% in 2024 and even lower by 2026. This slowdown in the world as second largest economy is a significant factor weighing on the global outlook. So, what does all of this mean for you, for the markets, and for your investments? First, let's talk about the market impact. The forecast for steady growth and declining inflation is generally a positive backdrop for financial markets. It creates a soft landing scenario where inflation is controlled without triggering a major recession. This could support stock prices, but the key variable will be central bank policy. Investors will be watching every move from the Federal Reserve, the European Central Bank, and others. If inflation proves more stubborn than expected, central banks might have to keep interest rates higher for longer. This is a major risk. Higher rates make borrowing more expensive for companies and consumers, which can slow down economic activity and put pressure on stock valuations. The IMF specifically warns that the final leg of bringing inflation back to target could be tricky. This outlook also has big implications for different sectors. With steady but not booming growth, companies with strong fundamentals, stable cash flows, and pricing power are likely to be favored. Think about sectors that are less sensitive to economic cycles, like healthcare or consumer staples. On the other hand, sectors that are highly dependent on cheap borrowing, like certain areas of tech or real estate, might face continued headwinds if rates stay elevated. For anyone with a globally diversified portfolio, this divergence between regions is crucial to understand. The outperformance of the US market might not last forever, and opportunities could arise in other regions as they begin their recovery. Emerging markets, despite their own set of risks, could offer higher growth potential, but they also come with more volatility, especially with a strong US dollar. So what are the biggest risks on the horizon that could derail this forecast? The IMF is very clear about a few key threats. First, geopolitical conflicts remain a major wildcard. Escalations in conflicts could lead to new supply chain disruptions and spikes in energy and food prices, which would reignite inflation and hurt growth. This is a constant source of uncertainty for the global economy. Second is the risk of what they call geoeconomic fragmentation. This is a fancy term for countries becoming more protectionist, putting up trade barriers, and retreating from global cooperation. We're already seeing this with trade disputes and restrictions on technology. This trend, if it continues, could make the world poorer by disrupting efficient global supply chains and reducing trade, which has historically been a major engine of growth. And third, as we mentioned, is the stubbornness of inflation. If core inflation, which excludes volatile food and energy prices, doesn't come down as quickly as hoped, it will put central banks in a very difficult position. They would be forced to choose between fighting inflation with higher rates, which risks a recession, or cutting rates to support growth, which risks letting inflation become entrenched. So, what are the key takeaways for us? 1. The global economy is showing remarkable resilience, but growth is expected to be modest, not explosive. 2. Inflation is coming down, but the fight isn't over yet, and interest rates will likely remain a key factor for markets. 3. There's a significant divergence in performance, with the US leading the pack while other regions like Europe and China face more significant hurdles. And 4. Major risks, from geopolitics to protectionism, still loom large. Navigating this environment requires a balanced approach. While the soft landing scenario is becoming more likely, it's not guaranteed. It's a time for careful planning, not complacency. Understanding these global trends is the first step in making smarter decisions about your finances, your career, and your future. The world is more interconnected than ever, and what happens at the IMF in Washington or in the markets of Beijing and Frankfurt has a real impact on all of us. That's a wrap on our breakdown of the IMF's latest global forecast. It's a complex picture, but hopefully this gives you a clearer understanding of the key forces shaping our world economy through 2026. What are your thoughts on this forecast? Are you feeling optimistic or cautious? Let me know in the comments below. I'd love to hear your perspective. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss our next deep dive. See you in the next one.